Hey everyone, happy March 29, 2024. I'm Phil Hodgen, and welcome to the Hodgen Law PC International Tax Lunch. Gonna have to figure out an easier name for that. We do this almost every Friday month on the last Friday of the month, noon Pacific time. The only times we change that is because if we were going to clash into some sort of tax filing deadline or holiday. So, but otherwise, here we are live and in glorious color. Or later, we'll get this recording up on YouTube and you can watch it there. You know, a simulation of reality on YouTube. This month is episode 11 of the International Tax Lunch Form 5471 series. So the final one, and we're going to settle in and figure out what does this all mean? We've dealt with the Sudoku of the 5471 and how it works. Let's zoom up and let's compare controlled foreign corporation taxation to a bunch of different other alternatives that an American entrepreneur living abroad might choose as an entity structure. So that's how it's going to work. I can't see the chat just the way things are set up, but Rachel is on grabbing the chat. And so if you throw things on, I'll be able to deal with them later. So help me out with some contact information, or you'll see the last slide has my email address. Email me and let's talk. So let's go. Okay, there we go. Now it works. So here we are. Here's the series, and we're at the end. I've got to confess, when I started, I thought, oh my God, can I go through all the way to the end? And here we are, and we're happy. Table of contents, just so you have it. We have the two kinds of structures we're going to be looking at, generally pass-through structures and generally controlled foreign corporation structures, and some conclusions and rants at the end. Introduction. This whole series, you're going to see that I have two basic theories in my life and my thinking about business entity selection generally and in the context of foreign operations specifically. The first is I treat what we do as tax professionals as just we're plumbers for money, or more specifically, plumbers really for data. And then the data affects how the money is treated, and specifically how much the government wants of that money that's in your pocket. So first thing, plumbing for money, buckets and pipes. The second thing that you will see, and it's not on this slide, but it's going to be pervasive throughout here, you can choose a pass-through type of entity if you want, sole proprietorship, partnership, blah, blah, blah. Or you can have pass-through treatment thrust upon you, controlled foreign corporations, subpart F income, global intangible low taxed income. And we'll deal at the end with the high tax exception, where you can actually engineer a classic subchapter C behavior for controlled foreign corporation. But in general, my personal opinion is if you're advising somebody, assume everything is passed through until proven otherwise, because that's the reality. So here's my little handy dandy structure diagram of what a business looks like and what happens. You have a customer on the left, and they give you cash and you give them a product or a service. And then everything, the data from the operations of that business and that sale specifically, and the cash go into this black box. And that's the entity that we're dealing with. That black box will munge around the data, and the black box may, depending on what you choose, have an entity level income tax imposed. And that's the little red thing down below, bleeding money. So buckets and pipes, our plumbing is leaking. And then the black box has input from customer and operations, and that has output to the tax return, the Form 1040. And the Form 1040 gets your accounting data and munges operational accounting into tax accounting. and computes a tax liability. There's a bucket of cash that's available to the shareholder. Some of that is going to go to personal income tax, and whatever is left over of that tax, the shareholder can go walk outside, go buy a beer and a hamburger with it. So that's how it goes. And in this presentation, all I'm caring about really truly will nod at the other factors, but we're really looking at the combined effect of the entity level tax liability for this black box that you're going to create, if there is an entity level tax, and the personal income tax liability for the shareholder. And again, my assumption is we've got a US citizen operating a real business abroad, no phony baloney stuff, making something, selling it. And again, as I said, we have pass-through structures, so example will be in this presentation, a sole proprietorship. We have controlled foreign corporations where pass-through treatment is thrust upon you with a lot of friction and inefficiency. Or you can get the subchapter C treatment for your controlled foreign corporation by the high tax exception, and we'll show how that works later and the implications of it. I tried to sit down and figure out all of the different possibilities, and this is most of them. You can see green ones are flow through, the sort of bluish, purplish, whatever color that turned out to be, are controlled foreign corporations, and that loud pink, whatever it is, are US corporations. And the loud pink ones in this case will be US corporations doing business abroad as a branch in a foreign country. In all the other situations, you have a sole proprietor, you have a human being in another country doing business as a sole proprietor. In the controlled foreign corporation, you have what's functionally a C corporation in the foreign country doing business. And for US tax purposes, it's a controlled foreign corporation with all the thrills and excitement that implies for the US income tax return. So you can see this, and then at the very bottom is the parent subsidiary structure that we're going to deal with, but otherwise there's direct ownership of the operating entity by the US shareholder. I've eliminated the branches here, the branch operation, so a US company doing business directly abroad, simply because I don't see it that much. I know that other people see it more often. So hat tip to Christine Dahl in the Netherlands, and she's saying, well, actually, it's not too hard for a US company to register and do business in the Netherlands. And okay, I don't see that. So I'm trying to follow sort of the Pareto principle. What do I see the most of? Let's solve the common problems. Let's understand the common problems and deal with the exceptions and the less common things later if we have to. So that's why I'm just eliminating the branches. And if you're here just because you want to learn about branch operations, sorry. So let's launch now into pass-through structures. And there are two of them here that we're dealing with, one of which is sole proprietor. And every country that I've ever seen has some variation on the theme of being a sole proprietor or sole trader or whatever they happen to call it. But the essence of it is that the taxable quotes entity, close quotes, is the human being. And for us, it's everything rolls onto Schedule C of Form 1040. That's where income and expenses is reported. You calculate your net profit, which becomes your taxable income, like that. The second one down is what's called a foreign disregarded entity. So you'll hear this referred to as a hybrid structure, where you have a company, and we'll deal with the details later, in another country, and you make a check the box election. So for income tax purposes in that other country, it's a C corporation and treated accordingly and taxed accordingly. And for US purposes, this is a disregarded entity, and the whole thing is treated as every dollar goes straight to Schedule C. So we'll see how that works. And here's just the words on the slide, because if you're keeping copies of this PDF on your hard drive, it's useful to have some of the words in a slide so you can remember them later. Now, one of the things that is important, but I'm going to cheerfully ignore for the rest of this process, is self-employment taxes or Social Security taxes. So you and I know that if we have a classic sole proprietor, that person is going to have a number on Schedule C, the net profit, and that's going to become self-employment income, and self-employment tax is going to be imposed on that, the tax return. What happens when you have a disregarded entity, and specifically for our purposes, a hybrid entity? Well, if you have a disregarded entity, your sole proprietor is doing business through an LLC in the United States, and the LLC is disregarded. This clause in 7701-2 says, no, for self-employment tax, even if you're working for this disregarded entity, you're still paying self-employment tax, not Social Security, as an employee of this disregarded entity. And the same is true for a hybrid entity. So you have a foreign corporation you made a check the box election for, and it's disregarded for US purposes. You're going to have to pay self-employment tax because all of the net profit has gone through to your Schedule C. And we'll see in a slide or two, the other country might have a different opinion about what's going on here. And here's the opinion. Just think of it this way. You have a classic C corporation in the other country, and this person is your client, the US shareholder, the US citizen owning this business, is in all probability going to be an employee of this company. And this is going to imply that the employee is going to be contributing to that foreign country's Social Security system, either because they have to or because they want to, because if you're an American living permanently in Spain or the UK or wherever, you either have to or you want to be paying into the national system so you can get the national health care coverage and things like that. So you're going to have the worst of all possible worlds. You're going to be contributing to a Social Security system in another country, and because you have self-employment income, you're going to be contributing to the Social Security system in the USA. What happens? Well, there are three solutions to this, one of which is there's this about 20-something totalization agreements. That's the fancy word for Social Security tax bilateral agreements between the United States and other countries that will solve this double taxation problem. The second solution is you suck it up and pay into both systems. Or the third solution is if the Social Security tax double taxation problem exists, can't be solved by the totalization agreement, you're going to choose a different structure. That's just going to be it. And, this is going to be a $15,000, $20,000 a year kind of number. So on the one hand, it's big. On the other hand, it's not big. And you're going to have to decide how much engineering you're willing to tolerate in order to eliminate the problem. So I just a little quickie, what's this hybrid entity thing? And the answer is, here's the simple explanation. Go grab the Form 8832 and the instructions. And the very last page of the instructions will have a list by country of entity types that are always per se corporations. No matter what, you can't make an election for them. They're going to be classified as corporations for US tax purposes. So first, you set up a company in that other country that is not a per se corporation. Second, you file Form 8832 saying, I elect for purposes of US tax to treat this foreign eligible entity, because that's what they're called, as a disregarded entity for US tax purposes. 3, every year you remember to do the Form 8858 on penalty of paying an overly excessive penalty. So that's all there is to it. It's once you've chosen the right kind of entity, you make the election and you're done. So let's talk about numbers now. And we're going to start to see what's the total worldwide tax load for each of these different type of structures that we're going to look at, and so you can compare them roughly apples to apples. Here's my little list of assumptions that I've made. You can see I'm ignoring employment taxes. Ignoring foreign earned income exclusion. Ignoring state income taxes if they exist. It's unlikely. I mean, for an American living abroad, you're unlikely to have it, but I'm just putting it there. And then you can see my tax rates assumptions where I'm assuming the tax rates are in the neighborhood, but slightly higher than US in that other country where the person is living. My profit and loss assumptions are I'm going to have gross revenue of 600,000 of zero of expenses. And the reason it looks like this is in my models, when I build out these models, I always have a line for expenses, which is salary compensation to the owner. This is the classic loan out structure in Hollywood, right? Where an actor contracts to be in a movie, gets paid $1 million, but say, don't give me $1 million, pay my corporation, loan out corporation $1 million, and then the corporation pays a salary out to the actor for reasons. And that way you have a C corporation that had $1 million in, $1 million out, net tax on a zero profit is zero. So when you're playing these games and doing these choices, you're going to see I'm dealing a lot with how do we get the money out, and I'm giving you examples of taking it out by dividend, but the other way is to take it out by compensation, and that's just going to see what does it look like, that compensation in the other country versus the United States. Taking money out by compensation, I got to say, makes the foreign tax credit on the individual level super simple. So here's my numbers. I'm going to look over the big screen so I can see it because I'm looking at the little screen with the notes. You can see we've got $600,000 of Schedule C income. We take away the standard deduction of $14,600, and there we have $585,400 of taxable income. I assume a 30% tax rate. The reason I do that is because my full spreadsheets for this kind of thing use the tax bracket calculation with the graduated tax rates. In all of the models that I run, the top marginal bracket that we're in with these numbers is 35%. But if depending on how things go, the average tax rate, tax from $1 ranges from 28.x% to 30.y%. So why not make it an even 30%? Because we just need to be in the neighborhood of correct. We're not looking for precision here. We're comparing one against the other. So it's reasonably accurate if you're saying 500,000-ish of taxable income to say an average tax liability of 30%, for what that's worth. Foreign country taxation, 35% tax rate, so 210. Foreign tax credit, remember the rule is that the foreign tax credit, you get the lower of what you paid in taxes to the other country or the US income tax liability on that income item. So in this case, we have the lower is the US tax liability, 175. And so that means the overall US tax liability under this scenario is a big fat zero, which is what we like. And you can see when we do the worldwide tax load, US tax paid at the personal level as well as the foreign country income tax paid, it's going to be the higher, the $210,000 at 35% in the foreign country is the only tax liability. And so the worldwide tax load of how much tax did you pay as the numerator and your net operating profit, 600,000 as the denominator, is going to be 35%. Now, a little example, you say, okay, hybrid ownership, why would you do this? I think one of the classic reasons is you would want to do this is because for reasons of business operation in the other country, you need an entity and you need/want a liability limiting type of entity. And therefore, forming a company there, like in the UK, a little limited company, and making a check the box election is extremely useful to you just as purely business operations point of view. Yeah, I mean, I don't know if all of you, but I suspect most of you have followed the same track that I have. I started off as a sole proprietor, then I went and I, for many years, operated as a C corporation because back in the bad old days, there were slight advantages for healthcare plans and all that kind of garbage. And now I'm an S corporation. But it's extremely useful to have an interposed entity to be the employer of employees, to be sign the leases and do all that fun stuff. And the same thing is true in the other country. So using a hybrid entity is frankly a great idea. And you can see that the numbers flow through. First column on the left, sole proprietor, that's our previous numbers. But look at the middle column, hybrid entity, and the hybrid entity in the other country pays all of profit out as a salary. Just heroic assumption. If it's from the US point of view, the fact that that payment out of the hybrid entity is classified as a salary in the home country means nothing. It's just a distribution because the shareholder slash sole proprietor is treated as owning the assets directly. So as soon as it comes in, it's the owner's money. So the foreign country tax rate 35% is going to be 210,000. So functionally identical whether you have a sole proprietor in the other country or you have a hybrid entity. But then you can see the far right column, you have a hybrid entity, again, C corporation in the other country and disregarded entity, therefore sole proprietorship in the USA. Now we're going to pay out all the money as a dividend. Well, at the 25% tax rate, that C corporation is going to pay $150,000 of corporate income tax in the other country, meaning there's $450,000 of cash left over. Dividend comes out, taxable in the other country at 35%, so $157,500. U.S. personal income tax liability on the dividend income after foreign tax credit is going to be zero, because whether you want to treat this as an ordinary dividend, taxable at 30%, or a qualified dividend, taxable at 20% long-term capital gain tax rate, the foreign tax credit is going to zero it out. Unfortunately, on this thing, I forgot to add a line for the net investment income tax. So there would be a 3.8% net investment income tax liability on the 450,000 dividend paid, which is actually going to make this dividend strategy even worse and make the worldwide tax as a percentage of the net operating profit even higher. So you can see this, and the other point about this is you can see that the game that you play when you are trying to decide, well, how am I going to suck the money out of this corporation and put it in the pocket of the owner so the owner can go spend it on whatever, personal. There's going to be a combination of probably of dividends and salary. And I know from talking to a lot of people in the UK, they like to set up little limited companies, pay a nominal salary and pay a big dividend. Anyway, you got to play this game back and forth a little bit to figure out what works for you and for the client. So that's in a nutshell what's going on with the pass-through entities, whether you use a true sole proprietorship or a hybrid entity for income tax purposes. You should expect the income tax load to be the higher of the individual load of the foreign or the US tax rate. So in my example, the foreign tax rate is 35%, US is 30. So 35% is what it is. And as you see, this is going to be the best we're going to get. It's only going to get worse and worse from here. Right. So let's go on to foreign corporations and specifically controlled foreign corporations. There are going to be two categories of controlled foreign corporation models that I'm going to talk about. This is the first one, and this is where income enters the controlled foreign corporation and comes out through the portal that's labeled Form 5471, tagged as Subpart F income or tagged as global intangible low tax income. In other words, this controlled foreign corporation's income is tainted by the rules of Subpart F and converted from whatever it is into one of those two categories of income, and it's going to drop onto the income tax return of the U.S. shareholder. There are three models here. Direct ownership of the stock, and so a human being is the shareholder of the controlled foreign corporation. The second one is, again, a human being, but there's a Section 962 election. And the third one is we're using a domestic C corporation as a parent to the foreign country corporation, which is categorized for our purposes as a controlled foreign corporation. Me personally, for the kind of people that I work with, they tend to not like this parent sub thing as a practical matter because you think about an American living in the UK owning a limited company as a sole shareholder. That's one level of complexity for UK tax compliance. Think about a US individual owning a US corporation that owns a UK limited company. Now you've got two levels of UK tax complexity to deal with. You have the ultimate US shareholder, and you have the US corporation that's a parent, and it can only add at a bare minimum paperwork brain damage, and it might create additional tax problems. I mean, for instance, what are the dividend implications when you're paying a dividend out of a UK limited company to a US citizen who is permanent resident of the UK, compared to what is the dividend and withholding implications if a UK limited company pays a dividend to a Delaware C corporation that has no engaged in business in the UK whatsoever. So it's a non-resident entity as far as the UK tax system, which then pays a dividend upstream finally to a UK resident US citizen again. So for practical matters like that, I tend to stay away from that unless it's absolutely necessary. So you can see that the tax differences in these three entities are not dependent on what happens inside this black box, which is the Form 5471 and all that BS that happens there. It is the 5471 has an output flow. Remember, buckets and pipes. So it goes into the bucket 5471, things wash around and come out a pipe, and the pipe ends up in a new bucket, which is the shareholder. And the shareholder is either human, it's a bastardized human / corporation chimera. Chimera is a Greek mythological monster with the head of a lion, the body of a goat, and the tail of a serpent, right? And so this is how I think of the Section 962 election. It's just a bastardized mashup of a bunch of stuff. And the third one is the parent subsidiary relationship. Now the output from the 5471 goes to a C corporation as a shareholder. And each of these has different tax calculations and tax implications, and we'll take a look at those. So just to reinforce it, we've got these three pipes coming out of the 5471 aimed at the 1040, and we're going to watch tax data and by implication, cash money, and how it flows through those three different pipes. And here's my little handy dandy structure diagram that shows kind of inside the CFC black box system how things work. So this is a US individual shareholder. You start at the top with operating profit, and all of this fun stuff happens in Form 5471. And out of the operating profit, well, I should say for US tax purposes is 5471. For foreign corporation purposes, it's the books and records of the company. Two things happen, one of which is the operating profit is reflected in the taxable income of the foreign corporation in the other country. And then the second one is the operating profit is reflected, munged around, and then comes out as Section 951 Cap A, global intangible low taxed income to the individual. And what you end up with is those solid boxes represent the tax liabilities under each scenario. And you're going to have tax liability at the corporate level in the foreign country, and you're going to have tax liability at the individual level on the operating income. We've still left some cash in the company, and we want to get the cash out. And so the whole little bits and pieces of structure on the left-hand side is earnings and profits. So we're going to calculate the earnings and profits of the company and distribute all of the earnings and profits out to the U.S. shareholder. That's going to be a dividend, and it's going to be a dividend in the foreign country. Our hypothetical U.S. shareholder is living in Spain or the U.K. or wherever you want to put that person. So they'll have dividend income for foreign individual income tax, and you'll calculate the tax liability. You'll have U.S. individual income tax, and in this scenario, the buckets of pipes work in such a way that Section 959 says, oh, those earnings and profits were previously taxed. Therefore, your taxable dividend is zero. Therefore, by implication, your income tax payable on this dividend must also be zero. So that's why it says always zero in that box at the middle. And then on the left, the net investment income tax calculation says Section 959 has nothing to do with the net investment income tax in Section 1411. Therefore, you're always going to pay the 3.8% tax on that dividend. And the combination of those 5 boxes, the solid boxes, is going to be your tax load, and you're going to calculate the total estimated tax for how does this thing operate efficiently or inefficiently for any given dollar of net operating profit. And here's how Section 962 makes the whole scenario a little bit more complicated. Let's look first at the operating profit, and on the far right-hand column, how the operating profit drops from the corporation down into the U.S. individual's income tax return. You start again with the idea that this person has an allocable share of the global intangible low tax income. I mean, I always assume in these models it's 100%, it's a sole shareholder. You're going to do a Section 962 tax calculation. This happens on the Section 962 statement that you do freestyle and bolt to the back of the tax return. And the tax calculation is at corporate rates. So this is the bastardized mashup of tax, individual, and corporate concepts. And the next thing that happens, which doesn't happen on the default CFC structure, is that the individual can take a credit for the corporate income tax paid in the other country against the individual's personal income tax liability in the United States, in Section 960. And so you end up with the net income tax on Section 951 Cap A income, which in all of the models that you're going to see is going to work out to zero. So in other words, you're going to have a tax liability calculated at the 21% corporate tax rate for Section 962, but the Section 960 tax credit will always be equal to and offset the tax liability calculated. So that's the first thing this Section 962 election does. So this is buckets and pipes territory for Section 962. Let's look at the dividend side of the equation. That middle column is where things change. So remember, if the U.S. human is the shareholder of the controlled foreign corporation and receives a dividend, Section 959 eliminates the tax liability. Well, with the Section 962 election, Section 959 does not work. Therefore, we have a problem, which is we have a bunch of dividend income that is taxable. So we're not going to talk. I talked about that last month in the comparison of Section 962 versus everything else. But you're going to have taxable income from this dividend where you didn't before. You're also going to have the ability to take a foreign tax credit to the extent that it's allowable, which may be zero. And in that case, you're going to end up with some tax liability, which is going to be on the dividend income. So unlike the direct ownership with no Section 962 election, where you can guarantee you take the cash out with zero additional tax liability on the dividend, in this scenario, you will almost certainly pay a tax liability. So, and then again, net investment income tax. So again, the major differences are in the way the Section 951 Cap A income is taxed, and primarily on the Section 960 credit, and how dividends are taxed, which is by Section 962D, which exposes a lot of the dividend to income tax liability. So those are my handy dandy inside the black box simplified version of reality pictures. Now let's look at the numbers. Foreign corporate income tax of $150,000 for both scenarios on $600,000 of net operating profit equals taxable income. CFC pass-through income on the individual level is going to be taxable for just straight CFC at the ordinary 30% tax rates, or for the CFC plus Section 962 scenario at the corporate tax rates, which will be 21%. Foreign tax credit, the final line for Section 960, disallowed if you are just a direct owner as a human of a CFC, but allowed if you are making the Section 962 election. So the total tax load on the net operating profits of a controlled foreign corporation, you can see the difference is the Section 962 election wipes out the U.S. tax liability on the pass-through global intangible low-taxed income as it goes through. Now we look down at the second part of this is the dividend income. We have $450,000 of dividends paid out because it paid $150,000 of corporate income tax on $600,000 of income. So 35% of 450,000 is 157,500. The shareholders' income tax rate on the tax liability, direct ownership. Remember, Section 959 says this isn't a dividend, so therefore zero tax liability. For the Section 962 election, this is a dividend, so there's your tax liability calculated for the dividend income. And now we go down to the foreign tax credit. If you're a direct shareholder, you don't care about the foreign tax credit because you have no U.S. tax liability anyway. So Section 904 says your limit to how much tax credit you can take is the highest, the lower of U.S. tax liability or foreign tax paid. U.S. tax liability is zero, so your tax credit allowable is zero. So fine. But for the Section 962 election, your tax credit allowable is the lower of the two, which is 135. So the foreign tax credit completely eliminates the U.S. income tax liability on the dividend. And so we have, finally, we add on the net investment income tax, which applies in both scenarios. And the total tax load on dividend income is going to be just the U.S. tax liability. And you drop everything down to the bottom, and you can see the percentage of total tax paid as the numerator on a fraction and 600,000 of operating profits as the denominator, and you can see the percentage rates. So what I take out of this conceptual model is that for an American living in a high tax jurisdiction, the foreign tax credit rules for Section 962 are going to eliminate the double taxation possibility of global intangible low taxed income or subpart F income, and will almost certainly eliminate the double taxation of dividends received. So the Section 962 election is an efficient methodology for people living in the high tax jurisdiction. Just my thing. But you'll notice total tax load 54.1% compared to 35% under the hybrid entity concept. Now my diagram for the parent subsidiary structure. Short answer is it's complicated and I can't be bothered. So you get Charlie. That's a meme from It's Always Sunny in Philadelphia for what if you don't watch that show. So let's look at the tax calculations for a domestic parent and a CFC subsidiary. So the idea is 600,000 comes in as operating profit for the CFC subsidiary. pay your tax in the foreign country, upstream the dividend to the parent company. The parent company upstreams a dividend as a qualified dividend to the US shareholder. What happens? So we start at the top. CFC subsidiary is going to pay its normal 25% corporate income tax rate, $150,000 of foreign corporate income. Okay. Parent company has passed through global intangible low tax income because it's the 100% shareholder of the subsidiary. It will have $63,000 of income tax at 21%. How do I get there? $600,000 of a combination of Section 951 Cap A income and Section 78 deemed dividend, which you have to gross up the income of that's passed through by the amount of foreign tax paid by the corporation if you want to take the Section 960 credit. So between the 450,000 of earnings and profits after tax plus add back the Section 78 deemed dividend of 150,000 for the foreign tax paid. That's how we get to $600,000 of pass-through income minus the Section 250 deduction, which I guarantee you is going to go away in a few years. And you have a 300,000 taxable income at the corporate level times 21%. That's 63,000. So that's how you got there. I made up a number here for the next little sets of numbers. I assumed that the foreign country says, oh, look at that. We have a US company as the sole shareholder of our domestic foreign corporation. We have a 10% withholding tax imposed on all dividends paid upstream to US holding companies. Even under treaty, that would be a reasonable assumption. So $45,000 of tax withheld at source. So $450,000 dividend paid, 45,000 goes to the foreign country tax authorities and 405,000 comes downstream to the US parent company. Now the US parent company is going to pay out that 405,000 of dividends, and it's going to be qualified dividends. And you can see my calculations here. We have dividend income received by the individual. Well, the individual is living in Spain or the UK or Canada or wherever, so has dividend income and pays tax at 35% there. Has dividend income in the United States, pays a lower tax rate, and the individual gets a foreign tax credit. Actually, that'll be in the other country will grant the foreign tax credit, right? Because the person's living as a resident there. So anyway, the U.S. income tax is going to be offset, and the total worldwide tax on dividend income is going to be the foreign country tax. And you can see the number, the tax liability calculation right there, 56.125%. So worse than 35%, isn't it? I'm giving you this variation on the theme. I'm eliminating the 10% withholding on dividends just to make a point here, not about the dividends, not about withholding tax or anything like that, but about my models and how a relatively small change, 45,000 of tax in or out of the model, can make quite a profound difference on the effective worldwide tax rate when you're doing comparison of one to the other. And the point of all of that is to say, when you are doing these kinds of calculations start with my stick figure models, but you need to add in the specifics about that country and that country's tax and that country's social security tax and all of the details, because it will make a difference. You can see that subtracting the 45,000 of tax withheld at source made a difference in the worldwide tax liability, dropped it from 56 point something to 48 point something percent. So it's a number, right? So all I'm saying is these models that I'm giving you are directionally correct, but the numbers and the percentages are not by any means accurate. There is no precision here. I'm just giving you snapshots of the spreadsheets that I create and use. There's some more in my full model. There are extra columns for what happens if we pay a salary out instead of a dividend and all that sort of stuff. But you can see here, I've calculated the subsidiary, and I'm not going to go through them. You know, the subsidiary's tax liability. This slide, slide 33, shows the U.S. parent company's tax liability calculations. And the most important thing you can see here is that the far right-hand column, where this is the summing of everything together, we have tax liability in, tax liability out, and the foreign tax credits are always offsetting the tax liabilities. So net tax on this global intangible low taxed income is always zero. And I have two separate areas, one for the Section 951 Cap A income and one for the Section 78 deemed dividend, just to clarify it. To give you, okay, so my brain, my spreadsheets, I'll tell you how I set them up. You do you. I do me. There are two things I try to do. Never have complicated models, calculations inside a cell that are hidden. So I want everything on the surface. Second thing is I try to think and build spreadsheets in syllogisms. Syllogism is a philosophical or any kind of argument. If A, then B. A, therefore B. So you'll see in these spreadsheets a little chunks. Each one of those is a syllogism. In a perfect world, there will be 3 lines, but sometimes you have to have a little bit more. And then the one down below says, if B, then C, right? And then B exists because I proved it in the upper level. Therefore, C exists. And then if C, then D. And I proved C in the upper level. So the input for the next argument down is going to be the output from the next level up. So that's what I mean by syllogism. So that's how I build these. And the second thing is, in all of these spreadsheets, all of the mathematical functions are plus, minus, multiply, divide. The only functions I use are max and min and round. I don't use anything else. And that's me. That's my caveman Excel style. Anyway, so there's the parent company's total tax on dividend income received. For the parent company receiving a dividend, Section 245 Cap A gives a 100% dividend received deduction. So cash comes upstream from the dividend, from the subsidiary's dividend into the parent company without any tax liability. And then finally, here is the math for the individual, adding together all the tax liabilities at the individual level. You can see in the far right-hand side, those areas are red because there's a net tax cost as compared to green, which is zero tax cost because income tax is offset by foreign tax credit, for what that's worth. I also use colors. You can see back to my caveman style Excel. The orange things are the only input variables. Everything else is calculated. So if you see a black number, it's all built in pluses and minuses or multiplications and divisions. So everything should cascade through. So that's how I got to 56.125, rounded to 56.13. All right, next, we'll wrap up with the high tax exception. So a controlled foreign corporation is a corporation that's owned more, by more than 50% by 10% or more of U.S. shareholders, blah, blah, blah. So you will have a foreign corporation. It will be a controlled foreign corporation. However, the income tax liability output, remember 5471 is data in one side, data out the other. The data out the other will look different. So whereas before in the previous section, when I was talking about controlled foreign corporations and the tax implications depend on the type of recipient that receives the data output from the 5471, here we're manipulating inside the black box to make the data output different. So it's irrelevant what type of US shareholder there is on the output side. It's always going to be a zero pass-through income. And here's my little handy dandy thing, you know, the variation, how the high tax exception works. And the most important thing to look at here is, let's look at the far right-hand column when operating income comes out of the controlled foreign corporation and to the U.S. shareholder. I'm going to show you the specific form, Schedule I-1 of Form 5471, where all this happens in the next slide. But what happens is there's going to be an output from the operating profit of the controlled foreign corporation. Excuse me, for reasons that are a mystery known only to God, Congress, and the Treasury Department, you start with gross revenue. So we're going to allocate all the gross revenue that is to become global intangible low taxed income to the U.S. shareholder. But then we're going to take an immediate and exactly opposite offset, the high tax exception. So in 600,000 of gross revenue, out minus 600,000 of high tax exception equals zero of what they call tested income. And tested income is the baseline ingredient for what eventually becomes global intangible low tax income. So if you're starting from a zero income amount, you can never have a tax liability greater than zero because you can never have an income greater than zero. So that's how the high tax exception works, by creating an immediate and offsetting made up BF offset, the high tax exception. And then the implications on the other side on the dividends. Section 959 says, well, if you take a dividend and it's paid out of previously taxed earnings and profits, meaning the earnings and profits were included in the U.S. shareholders' income tax return by Section 951, Subpart F income, or Section 951 Cap A, global intangible low tax income, then you get those distributions, which are dividends, out of previously taxed earnings and profits with zero tax. Well, the high tax exception says nothing gets included in the U.S. shareholders' income. Therefore, this is just a normal C corporation with normal untaxed earnings and profits. And if and when those earnings and profits are distributed to the shareholder, it's going to be a normal dividend. And so that's what ends up happening. This controlled foreign corporation behaves exactly the way that you would expect a normal C corporation to operate, except it's a controlled foreign corporation, which means you have the BS of all the tax return crap that you have to do. I think I've said before, I think Form 5471 is the worst thing the IRS has published yet in the tax compliance world. And you can fight me on that. So here's the example. You can see we have line one, gross income coming in, 600,000, high tax exception coming out, minus 600,000, and total exclusions. Line three is the subtraction. Line four is the result of line one minus line three, zero. And there's tested income. Line six, nothing. And that's how it works. High tax exception, in a nutshell, what that means is the corporate income tax rate in the other country is 90% of the US corporate income tax rate or higher. So 21% times, that works out to 18.9%. So, you know, if you're operating in a country that has a tax rate that's higher than that, then off you go. So, what this means is you're going to have a Form 5471 game to a certain degree anyway. I mean, the fact that you're zeroing out tested income means that you don't have to play around with Form 8992 and 8993 and all that stuff. But you're still going to have a paperwork overload, but at least the thing is going to operate fairly cleanly. You're still going to have to track earnings and profits. You're still going to have to do all that fun stuff. Also, you've got Section 1248 that says when you sell the stock, some of the untaxed earnings and profits may be recharacterized as a dividend. But otherwise, it's going to operate like a C corporation. If that's useful to you, Vaya con Dios. So here's the tax calculation I've done here. Foreign corporation pays 150,000 of corporate income tax. Dividend out 450,000. It's all out of untaxed earnings and profits. So foreign personal income tax paid 150,000, 157,500 as usual. U.S. shareholder, I've just arbitrarily assumed this is a qualified dividend. So 20% of 450,000 is $90,000. Foreign tax credit, lower of U.S. tax liability or foreign tax actually paid is the tax credit, so negative 90. Net investment income tax, 17,100 that gets paid no matter what. And yes, I know there was that tax court case, not tax court, I think it was Court of Claims with the tax treaty between the United States and France, at least temporarily, you can claim the foreign tax credit against the net investment income tax until either Congress or the courts change it. So if you have a client who is a US person living in France and there's dividend income coming upstream and you want to use foreign tax credit for French taxes on that dividend paid to offset not only US income tax, but US net investment income tax, go for it. So you can see total tax. And again, just my example of the spreadsheet. And you can see here my syllogisms. We start with that first part, gross income tax, foreign corporation gross income minus deductible expenses equals taxable income. You see my next little syllogism down below starts with foreign corporation taxable income. If A, then B, A, therefore B. And now foreign corporation taxable income is B. If B, then multiply by the corporate tax rate 25% equals tax, and on and on and on. And more numbers. This slide, and I'll leave it for your reading pleasure later on slide 43, why there is zero tax on the global intangible low tax income is because there is zero tested income. And therefore, when you take your zero tested income and you go into Form 8992 to calculate global intangible low taxed income, you're going to end up with a zero. And the high tax exception, how does the shareholder get taxed on the dividends? I don't have the summary and the grand totals at the bottom, but you can see how I calculated the dividend taxation of the individual U.S. shareholder living abroad. So there's the conclusion. We're almost at the end of 60 minutes. Here is my little summary of the different percentages. You can see that in my models and my opinions, given my biases and my blinkered ignorance, I think the pass-through structures are a really good idea. I recognize that sometimes it's not always possible, but you can see it's kind of like, okay, when I was in high school, I rebuilt the engine to an old pickup truck that I owned. That was high school shop. And to test it out, put the engine in the truck and drove it with just a straight pipe out, right? Which is maximum efficiency for an engine, but kind of horrible for noise and pollution. Now we have a muffler and a catalytic converter and all that stuff, which makes the engine much less noisy, so we don't bother the people on the street and we don't pollute the air. Well, it's just great, but it adds inefficiency to the operation of the engine because the engine cannot expel the exhaust quickly and efficiently. And so you can see here, by adding more complexity for subpart F, we've increased the inefficiency of the whole model by increasing the tax liability. So back to my original metaphor, more water's leaking out of our plumbing that we created. Tax isn't the only consideration. I mean, there's a lot of business considerations that are going to force you to do what you can do. And quite frankly, banking is the biggest one for me. I'm wrestling right now with trying to get banking for an entity in Colombia that's trying to do business. And it's hard. The KYC and all of that stuff is just a pain in the ass. Liability protection. I mean, anybody who has any brains wants liability protection for owning and operating a business. And you also just want to abstract away the complexity from your tax return. Quite simply, I mean, for an audit probability in the United States, you have $1 million Schedule C. You look kind of like a big fish in a small pond in the 1040 department, right, for self-employment. You put $1 million on a subchapter S corporate, 1120S, um, on a corporate return, you're going to look like a very small fish in a very large pond, and your liability for your risk of audit is going to go much down, a lot lower. The 1040 you file is going to look super simple: a K1 plus a W2, and off you go. So there are those considerations. It's not just pure dollars out for income tax. That's important, but it's not the only consideration. My suggestion is that if you can't look at the pass-through kind of concepts, and you have to use a corporate structure of some kind, think about ways first that you can do salary and bonus to pull money out. I personally believe that you are not a freestanding human being until you've pulled out all of the profit from your company and you have it in your own pocket, and the government can't say a damn thing about it. And for those of you who doubt my hardcore belief, just remember the Section 965 truck that hit a lot of your clients in 2017. They were sitting happy on undistributed earnings and profits in a CFC, and guess what happened? The government held the sword of Damocles over their heads, and guess what? It fell. So the bigger story on this slide here is to tell you that if you are dealing with unacceptable income tax results as a result of the architecture that has been thrust upon you, think about operational things that you can do to mitigate the tax liability. For instance, bonusing out a lot of profit, taking it on the income tax return of the owner/employee. So, in summary, choose the efficient pass-through structure if you can. Accept begrudgingly the inefficient pass-through structure if you must, or choose the high friction because there's a lot of crappy paperwork, high tax exception corporate one if you must. And that's kind of my thinking process for all of this. There I am. We're at the end of 11 episodes of Form 5471. Next month, we're going to launch into 5 episodes of FIRPTA, Foreign Investment in U.S. Real Property Tax Act. So email me if you have questions about 5471. Email me if you have things that you'd like to hear about foreign investors in U.S. real property that I can build into the next 5 episodes. And thanks for watching. I'm done here.